Today, we'll be going through the August 4th, 2026 U.S. Market Deep Dive Analysis Report. Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
This video presents a direct informational narration of the source document.
Here is our agenda for today. We're covering 1. Macro and geopolitics, 2. Monetary policy, 3. Market performance, 4. Tech earnings, 5. Sector trends, and 6. Observations and risks.
Section 1, Macro Environment and Geopolitical Dynamics. This is where we see the strategic turning point driving this explosive market rally through eased inflation expectations and lower energy costs. We're looking at a near-finalized agreement for the Strait of Hormuz, and the mechanics here are actually pretty fascinating. Basically, vessels entering the route will hug the coast near Iran, and those exiting will stick near Oman. Both Iran and Oman are going to split the shared service fees right down the middle. And we know this is actively moving forward because the Iraqi oil ministry has already explicitly confirmed that its crude oil tankers have successfully passed through the strait.
Now, behind the scenes, there is a serious three-way diplomatic chess game playing out. On one hand, you have Saudi Arabia stepping up to fund back-channel Houthi mitigation efforts. On the flip side, Iran is literally considering letting European countries participate in minesweeping operations.
So, what does this all mean? Well, the source document views this as a total victory for Iran in terms of controlling the strait. The U.S. essentially conceded to avoid a ground war. The White House accepted this Iranian control specifically to lower oil prices right before the midterms. Because of this massive strategic concession, the U.S. military is essentially in what analysts are calling garbage time in the Persian Gulf. And this is absolutely crucial because this concession directly drives Treasury yields down.
Let's move right into Section 2, Monetary Policy and Inflation Observation.
You can see a very clear relationship playing out here. The plunging international oil prices and fading risk aversion are directly causing a continuing decline in the 10-year U.S. Treasury yields. It's like a massive market-wide cooling of fears.
Because those inflation fears are fading so fast, September rate hike expectations are rapidly revising down. And what happens then? Funds are aggressively returning to risk assets. This improves market liquidity and builds up this powerful psychology among investors that the bad news is out.
Which leads perfectly into Section 3, Market Performance and Liquidity Logic.
Just look at these S&P 500 milestones. We are looking at a breakthrough of 7,700 points for the very first time in history. The total market cap has officially surged over $70 trillion, hitting an intraday high of 7,758 points. And you know, this isn't just hot air. These current valuations are heavily supported by strong corporate earnings growth.
But here is where it gets crazy. A severe structural divergence triggered a violent short squeeze. On one side, we had massive short positions stacked up in index futures, including bets by well-known shorts like Michael Burry. On the other side, steady net inflows kept pouring into ETFs like SPY, VOO, and QQQ. Once key resistance levels broke, boom. This structural divergence forced an absolutely frantic wave of position covering.
The scale here is just staggering. Market whales deployed over $10 billion to absorb positions from liquidated large shorts, like the trader known as 6UBA. They just scooped up all those cheap chips, and that massive capital influx drove the market straight to new highs.
Section 4, Core Tech Stock Earnings Analysis. Diving into Q2 tech earnings, let's look at SX first. They hit $7.8 billion in revenue, which is a 92% year-over-year jump, and the loss actually narrowed to $540 million. But they're facing heavy pressure from an August 6th lockup. Then there's AMD. Incredible numbers here, $11.5 billion in revenue, up 50% year-over-year, pulling in a $2.3 billion net profit. The biggest takeaway, their data center revenue hit $6.7 billion, making up a massive 58% of their total revenue.
So why the weird market reactions? Well, AMD is facing a catch-up drop from profit-taking after outperforming back in July. Basically, funds are just locking in those stellar gains. SNX, on the other hand, is facing hesitation. Short-term funds are just stalling, opting to step aside to avoid that massive share unlock coming on August 6th.
Moving on to Section 5, Sector Trends and Specific Industry Analysis. We really need to define this risk, the valuation kill. This is a severe contraction in valuation multiples faced by utility sectors in high-interest environments, specifically if their earnings guidance isn't continuously upgraded.
For example, the source notes an energy company that hit 504% net profit growth, but the stock was still heavily sold off just because it missed revenue expectations and had stagnant full-year guidance. Brutal, right?
Looking closely at Tier 2 AI data center infrastructure, we're comparing CIFR and AIN. CIFR saw its loss expand to $267 million, but they are delivering their first AI center 2 months early, backed by an Amazon pact. AIN, meanwhile, has a clear transition logic and an upgrade window supported by a Microsoft pact. While CapEx naturally expands short-term losses for companies like CIFR, the transition speed is really what dictates their long-term valuation ceilings.
Finally, Section 6, Analyst Observations and Risk Warnings. The analyst's conclusion here is crystal clear. A market correction right now is just a healthy pullback. It is not a trend reversal as long as the S&P stays above its 5-day moving average. They're advising a bullish stance. And there's a stark warning for the bears. Fighting this unilateral momentum is dangerous. Long-term shorting is rendered nearly impossible right now by Fed QE tools, massive BlackRock ETF passive buying, and overarching policy support. Major short positions like Michael Burry's have significantly shrunk.
To wrap up, the report outlines 4 specific risk points. First, technical support holding at the 5-day moving average. Second, the unlock impact on August 6 for SX. Third, geopolitical reversals, like delays with the Hormuz Agreement or renewed Houthi clashes. And fourth, valuation mean reversion due to utility earnings misses.